with Richard Crouch. Richard's business and commercial transactions practice includes commercial and real estate acquisitions, dispositions, leasing, development, and finance. He consistently works with real estate acquisition firms, developers, property management groups, commercial tenants, and lenders in the structuring and closing of commercial transactions. Without further ado, welcome to the show, Richard.
Thank you. I'm very happy to be here.
Okay, well, we're glad to have you as well and to have a seasoned person on the show. And that's not a jab at age or anything like that, but just years within the business and your pedigree is really impressive. And so we're definitely looking forward to the talk on today and the different things that we'll cover pertaining to commercial real estate law. But before we get into those details, if you could share just a little bit more about yourself and also how you got started in real estate, that'd be great.
Yes, I went to law school after undergrad. I double spidered at the University of Richmond, and I was very fortunate to get connected with a good firm. It's the only firm I've ever worked at, and it's been about 24 years, so it's definitely a special place to be and kind of a rare thing to stay somewhere that long. But no, it's been wonderful, and I think probably one of my biggest blessings when I started, there were two productive partners at my firm that specialized in commercial real estate. And so that's really how I jumped in. And they were both just excellent mentors, one of which was very good at the technical nuances, what to be afraid of missing, what to look out for your client. And the other mentor basically taught me everything they don't teach you in law school in terms of how to manage a business, how to attract and retain clients, and was particularly impactful in reminding me of the mindset that time kills deals and to be very responsive and always moving forward. So couldn't be more blessed to have them. And you know, it's interesting. One of them's still practicing, and then the other one is teaching yoga in South Beach. And it's like somebody out of a John Grisham novel. But I'm incredibly appreciative because the things they taught me, I literally use every day, and they've all become very second nature to me. And having a good mentor definitely prevents you from making a lot of mistakes and definitely sets you up to do well in the future.
Yeah. And so just based off your bio and our brief conversation before we went live, you could tell that you're investor centric and that you think like an investor, and you're also an investor. And so that's always handy to have when you're dealing with legal, because as investors, we need someone to have our best interest in mind and to be able to step in our shoes, so to speak, and be able to lead us into a profitable investment. So that's really good, Richard. So if you could just kind of elaborate briefly on within the market we're in today, we're in higher interest rates as of 2025. You've been practicing somewhere close to 20 years plus. Share some of the differences that is within today's environment compared to when you first got in, and just some things that specifically has changed.
Yes, I was when I was a young buck, and this would have been 2001, pretty much to 2008. Things were humming along. There were a lot of syndications going on, even in sectors that aren't anywhere near as popular today. But as many people might recall, with the great financial crisis and some of the reasonings for that and some of the valuations associated with that eventually crumbled, as you can imagine, in around 2008, 2009, things slowed down a bit. I think the fundamentals were a lot different. There are a lot more fraudulent aspects and a lot of rating agencies that really shouldn't have been giving the ratings that they were giving at that point in time. And so a lot of real estate, particularly residential real estate, plummeted in value. What's happened more recently, although it has still had the same result of slowing down the transactional volume, a lot of the fundamentals there in terms of the overvaluation and a lot of the more shady practices that you saw around 2007, 2008 don't seem to be present. It seems a lot of it is attributable to the spike in interest rates to slow down inflation. And for a lot of our clients that are used to doing syndications, and acquisitions, a lot of them are still having difficulty making the deals pencil. So we're busy enough to keep the lights on right now. You probably would find a lot of transactional lawyers that say the same thing, but it's the type of stuff that keeps the lights on, not necessarily the type of work that pays your bonus. So definitely looking forward to transactional volume, particularly acquisitions picking up. But I'll keep listening to the various pundits and in terms of their forecasts as to when interest rates might come down and a lot of the acquisitions might accelerate, or seeing when syndicators find other more creative ways to make deals work.
Yeah, so I've been following those pundits and listening to all the different sources speak about what was going to take place. And a lot of guys would have thought that transaction volume would be much higher than where it is as of right now within Q1 of 2025. But really, to be honest with you, pricing still hasn't dropped enough, at least from the deals that I'm looking at. It's just we're not getting the numbers that we need in order to be able to pull the trigger. And there's tons of cash on the sidelines. There's tons of individuals ready to get into the game, but the pricing hasn't eased enough to be able to pull the trigger on some things and achieve the proper metrics that investors actually absolutely want. So hopefully that pans out and some of these guys start hitting on some of these predictions.
I'm looking forward to, and sorry, I didn't mean to cut you off, for my own personal investments. Fortunately, they're all cash flowing, some much better than others. But I am looking forward to that time where I can do that final refinance, pull some cash out, and pay for certain deferred maintenance and things along those lines, as well as acquire new properties as well. But yeah, there are a couple variables where, fortunately, I'm holding pretty well in terms of cash flow. But yes, once those points come down, I'm definitely going to be breathing a lot more comfortably. But yeah, for now, I've basically, any of the capex and the deferred maintenance that needs to have been done, I have mechanisms for that, such as a HELOC that has a pretty decent interest rate on that. But hopefully, in the years ahead, I'll be able to pay that down for my own personal investments and have it be in a much more positive cash flow situation. So I'm sure there are quite a few people in the same boat.
Okay, and so you do a lot of transactional assistance and you help investors quite a bit with that. Out of the deals that's getting done that have been brought to you here recently, what was the most prevalent ways that people were able to get these done? Were they assumptions? Were they off market? How are guys absolutely able to make things work at this point in time?
I think for acquisitions that you're still seeing occur, a lot of those, the equity is being self-funded. So that's not the answer I'd like to give, but they're basically deals. It's actually, in some ways, it's not unlike the GFC, where people were still closing loans, but they were really those solid borrowers that could basically afford to have different ratios in terms of their debt service and the percentage of loan dollars that they needed. So if they were doing deals at 50%, which I know is not ideal, they're still able to do those deals. And so that's what we're tending to see, is where they're basically self-funding their own equity and they're in a pretty good position. I'd say maybe the last 2 years, you're just not seeing as many of the traditional syndications and the loan percentages that you would have seen in, say, 2020, 2021.
Okay, and as far as the disposition side of things, what are you seeing on that front? The people that are going to market, even though this really isn't a really good time to sell, what are you seeing out of that, and what are their motivations?
Yeah, sometimes there is a 1031 that they want to take advantage of. Sometimes they want to get into a larger asset. So sometimes you'll see that as a motivator right now. And sometimes with the syndicators, they're comfortable enough with the valuation, they're comfortable enough with the purchase price, and they usually have a predetermined range of time that they've told their investors that they would sell. So they might have like, that 7 to 10 year window. So that's something that's driving that as well. One other less favorable situation that you're seeing that sometimes is prompting the sales is if they have a maturity date coming up on their loan, and they are basically certain that it's going to be a buy-in, cash-in situation to refinance, and they would prefer to actually simply exit the asset. So not ideal in that situation, but sometimes it may be the lesser of two evils than trying to refinance when they realize the valuation's not going to be there.
Yeah, I know it's been hard for me to comprehend because this is just not really a great time to sell. And so either they're in trouble or some other things are motivating them to be able to or to bring an asset to market, even though the interest rates are so much higher, in which is forcing us as investors not to be able to offer as much because of that in order to achieve the numbers that our investors are absolutely needing. So that's really good information. And as far as developments, and so I know that within your bio, it mentions that you assist investors with development. What are the attractions and the draws towards developments during these high interest rate times? Because I have seen some investors pivoting towards more development sides or development investments. What's the attraction? What's the attraction in that? And is there any advantages, or what's your take?
Yeah, right now I'm not seeing as many of the traditional value add sort of development work going on, mainly because if you're using that BRRRR strategy, the refinance component isn't as favorable as it was. So right now in my particular area, in terms of people investing and doing development work, a lot of those are actually land deals. Where they're basically getting property rezoned for residential. And if they can get it rezoned, they basically make a play where they sell it to a much larger, like a national builder that really wants to get into the market. And once they get the property rezoned with the density that the builder really favors, they're able to sell the land for quite a bit of money. So that's another thing that's actually keeping us pretty busy right now. And although the clients that are selling the property do have some carry costs associated with that, it's been very manageable, and their paydays once they finally get the rezoning and sell are millions and millions of dollars. So they're doing extremely well. And here's one thing that I have seen that's pretty creative that one of the developers has been doing is pretty much they're in sale mode right now. They're pretty much primarily doing dispositions of their land, and in their sale and purchase contract, you typically would see an earnest money deposit like you'd see in any other contract. But what's very interesting is they've set all of them up so that the deposit itself from the purchaser, the seller is able to actually start to use it before the purchaser even closes on the acquisition. And I'll explain that in a little bit more detail. But basically, the seller is starting to use these deposits to chase other deals, buy other land, make other deals work, maybe handle some of the rezoning costs or development costs on other projects. And the way that they make their purchaser comfortable is the seller actually will sign a promissory note and let the purchaser record a deed of trust or a mortgage instrument against the seller's property so that in case they default, the buyer actually has some recourse to get its deposit back. And I've been doing this about 24 years, and that's actually the first time I've seen that mechanism that sellers of land are basically able to get some immediate liquidity, so long as it's properly documented, to chase other deals. So again, these are mostly land deals that we're seeing, and most of it's being rezoned for residential, but that's some of the activity we're seeing right now.
Okay, so it sounds like they're doing basically some flips with the land. What is the turnaround time on that? If they're buying property, having it rezoned, is there an average or a rule of thumb that it typically takes, like some type of timeline?
It would usually, for something like that, because you have to deal with planning commissions and city council, and sometimes you're at the mercy of their schedule as well. So it's definitely not like a 30, 60, 90 day duration of the transaction. Usually, a lot of those contingencies that need to occur in terms of the rezoning or certain approvals, it's going to take probably at least 6 months to get that done. So a deal like that could take as much as maybe a year, unless it's particularly complicated. And I think if you increase the size of the deal and the various improvements that maybe the city or the county want to have, that can increase the longevity of that deal. But I would say a minimum of 6 months, and 6 months to a year would kind of be the average for those types of deals.
Yeah, and that's not bad. I mean, because the average turnaround to be able to add value to a multifamily value add deal, you're probably gonna reach stabilization in year two, and so a year to be able to make a couple of $1 million, that sounds like a great opportunity and a great investment. So I'm curious, what type of creativity have you seen as far as investors being able to get deals to the finish line in a higher interest rate environment? Um, we as investors, we're known for trying to think outside of the box and be able to figure a way out to be able to structure deals to make it make sense. Have you seen anything that's really been unique, especially with your 20 plus years experience?
I would say the most memorable deal that I can remember, and I was really proud of not only the client, but the work we did, because he really was starting towards the beginning of his career, and he had had a lot of um, ups and downs in previous careers, and he had got interested in real estate, specifically multifamily. And the deal that he was chasing, he really was not in a position in terms of financial wherewithal to be financeable. He certainly had no equity. He didn't really even know how to begin the process of raising equity and meeting accredited investors and things like that. And we took an interest in him, got him under the engagement letter, but definitely floated him for a while. We weren't insisting on payment every month and things like that, because we knew that that would basically stymie him and he wouldn't be able to get the deal done if we did that. So I think probably start to finish, it was probably 6 to 9 months before he finally closed. But what he had found was basically a large multifamily project. And I don't normally recommend that people jump into a 300 unit deal if it's one of their first projects. But he knew it was very undervalued. He knew that the company that owned it was looking to jettison it from their portfolio. They had tried to make it work, and they couldn't. So he was getting a pretty good deal on it, but he still was struggling with the issue as how does he finance it, because his own his own balance sheet was not strong enough for it, nor did he have a guarantor that was strong enough. And so what he was able to do was basically structure the capital stack so that he basically did a subject to deed of trust or mortgage. So his seller's debt stayed in place, and he had to continue to pay his seller so that the seller could pay their mortgage. So that would stay in place. In addition to that, he got seller financing to basically cover the rest of the purchase price. And I think coupled with everything, he maybe bought it for about $13.5 million. And he was able to get it leased up. Now, he did have a good team of people, which is what I would recommend to anybody. Know what you're good at, know what you're not good at, and surround yourself with good advisors and a good team. But they did an excellent job of getting people to renew leases and filling up the various units involved, so that within the span of, and I really don't think it was more than 9 months, he was able to refinance that multifamily project, the one he bought for $13.5 million, for $50 million. And that is a tremendous delta. And it's honestly the only time I've ever seen a swing that dramatic in terms of value. He was able to add loan dollars he was able to obtain. And of course, he was able to use that for pursuing other projects as well, because all of a sudden he had tons of equity, and it changed his life. He went from somebody who at most was barely covering his credit card payments to having a net worth of, once you kind of factor in everything, over $30 million. And he hit an absolute home run. And one of the most creative provisions, in addition to the whole capital stack and how that was structured, is there was a provision in his operating agreement to his investors, and it was in the subscription agreement as well, that said that if he basically doubled their initial capital contribution in less than 2 years, their membership interest would be deemed fully redeemed. Like basically he would pay for it for $1 and they could exit out of the deal. So the reason he was able to capture so much was because basically he was able to return, 2 times the initial capital contribution to each investor. And all of a sudden the property was his and it wasn't anyone else's. And so very dramatic. And that was it wasn't just creative documentation, because we can paper anything, but a lot of it has to do with the parties involved, how much they're willing to work. And I did tell him quite a lot. A lot of this depends on your ongoing communication and transparency with your seller, because your seller could put you in a rough position. If your seller just stopped paying their mortgage or didn't think you were performing in terms of maintaining a certain standard and quality of the property itself, they're in a position where they can take back over. They also have a deed of trust in their own favor because they had that seller financing component as well. So he really took that to heart too, and made it work and kept his seller happy, so that nobody really had to even analyze how to enforce their remedies. So that's just one of the things that we're the most proud of, and he's still humming along, doing pretty well. I think he probably is having similar struggles just with the current level of interest rates, but in terms of getting new deals. But he's also stabilizing everything else that he was able to acquire in that time frame. So we just definitely love being able to do stuff like that. And the other thing that we did do that I didn't mention is during this whole process, as he was trying to find financing and so on, we introduced him to a lot of lender contacts because he was still new. But I think probably one of the most meaningful parts as we introduced him to an equity source that was able to cover that initial equity that he needed to do the deal. And these are the same people that basically got their interest redeemed less than 2 years later, but without that component as well. And I forget how many millions that had to be to make the deal work. We were able to make those introductions for him as well. And so it was definitely a team effort. And I think him doing it by himself, I don't think there's any way it could have been done, but I also admire his ambition and his hustle to continue to make it work. So that's just one example of what we do, but it's one that I think about quite a bit.
Yeah, that was a home run. First off, to get your investors to sign off that if they had their capital returned to them in a couple of years, they would basically walk from the deal. That's a outstanding in itself, and to be able to walk away with 100% ownership in that property, that's a great investment. So what areas do you guys work within? Are you guys nationwide, or do you prefer to be in the Sun Belt area or the Midwest? Where do you guys work?
I would say for clients of mine that buy, so I'm currently licensed in Virginia and North Carolina. The firm I work for, we have attorneys licensed in 19 different states. So we have a pretty big reach, but if we are doing a deal in a state where we maybe don't have a licensed attorney, we have a network of local attorneys that we collaborate with, because there are certain things that are state specific in terms of those nuances. And it's honestly best practice to involve a locally licensed attorney to review the deed, review the loan documents. And actually, in most cases, if there's a lender involved, they're going to want an opinion letter from the jurisdiction in which the property is located. So we have done deals all over. I would say most of the deals are in the Southeast that we've done. A lot of our clients, whether it was multifamily or even the ones that were investing in suburban office markets, they would focus on areas like Atlanta, Raleigh, Nashville was another one. Anywhere where there was a fairly young demographic, a lot of high-tech jobs. Oftentimes it was helpful if it was a college town, and if it had, it was also helpful if it was a capital city like Nashville or Atlanta. or Raleigh, where there are a lot of legislative jobs as well, because that basically would help provide the people that needed the space for office or for multifamily. And so the deals that we've done outside Virginia and North Carolina, which these days tends to be more often outside the state than inside the state, are usually in those areas of growth.
Okay. Yeah, we've got a huge presence in the Southeast. I know a lot of my colleagues, they're based out of the Florida area, and then into the Carolinas, there's a really good presence there as well. One last question I have for you, Richard, is what is the benefit of working with a syndication attorney or an attorney that assists with counseling and syndication docs? What are the benefits of that?
Yeah, I think one area that people overlook or they tend to discount is how important it is to properly memorialize the deal terms, because everybody's excited at the beginning of the deal. I mean, what could go wrong? And a lot of people, you'd be amazed how oftentimes people do not reduce it to writing, or they kind of try to fumble through it themselves. And what they do prepare may not be very, very clearly worded in terms of what is the hierarchy of distributions, what are the standards of performance. And you would be amazed how many operating agreements really don't talk to that. They basically say this person is the manager, this is what they're authorized to do, this is the purpose of the company. And then it probably will have a waterfall distribution section that says for income from operations, this is how it will be distributed. For capital events, this is how it will be distributed. You might have language along those lines. But one thing that you oftentimes don't see that you really should have in there is what are the metrics going to be for the manager's performance? Because if the asset tanks and the manager does nothing, that's not going to give warm and fuzzy feelings to the investor whose equity is at risk. And so it is helpful to have things like, okay, if you don't make one of the returns for maybe two consecutive quarters or maybe even 2 or 3 months, what are the mechanisms in place for that? I mean, are you going to submit a business plan as to how you're going to improve it? And to have something that's a little bit more clear, and it actually, truthfully, benefits both the investors and the manager to have that much clarity to say, okay, how are we going to determine that I have performed? And if I'm not performing, how are we going to address it? Now, if the parties are very level-headed, you would hope that those conversations and that level of transparency would occur anyway. But it's nice to at least memorialize that understanding in your operating agreement. The other thing that people oftentimes overlook, and again, it's because everybody's so excited at the beginning of the deal, is what are your exit strategies going to be? So they can be something where it's clearly, it's a date certain. It's a certain event, like when we're going to sell it or do a 1031 or refinance, this is how distributions are going to be handled and so on. But oftentimes what people don't focus on is, okay, absent that date certain, what if it's something else like the death of a member, the disability of a member, the bankruptcy of a member, or simply a member's desire to disassociate from the company because the project's not doing as well? And so what sort of mechanisms do you have for that? What type of notice do you have? How do you do the valuation for what your membership interest is worth? And there usually, or there should be anyway, provisions that if one member wants to leave, the other members will usually have a right of first refusal to buy basically their pro rata portion of the membership interest. And again, you'll have mechanisms for how that's valued. Maybe have some alternative dispute resolution mechanisms too, maybe mediation and arbitration if the parties can't agree. But hopefully the mechanisms for the buy-sell are clear enough that it's just an issue of following those steps and compensating the exiting member. And there are various provisions you can do. You can have basically a call option where either you're allowed to buy the syndicator's interest, or you can have a put option where they have to buy your interest. And there are things like tag-along rights and drag-along rights where basically one party can compel the other one to sell. And so that's another thing that people tend to overlook, but it's really important to have those provisions for when things don't go as planned. And the last thing that comes to mind, particularly in times like right now, where maybe meeting some of the financial or the debt service covenants is more challenging, particularly for sectors like office, is to have basically certain mechanisms that address situations where if you need additional capital to be contributed by the investors, what are the mechanisms for that? And so usually having a provision that clearly says that the manager can determine that capital contributions can be made down the road to sustain the asset are really important to have in there, and to also have provisions if one of the members decides not to contribute additional capital, what happens to their interests. And usually that's going to be diluted. But you can also have mechanisms that incentivize investors to continue to contribute to the project if needed, so that they're not just simply waiting for others to contribute on their behalf. So that's one of those things, because oftentimes when you get into troublesome situations, you might have a loan maturity coming up, or the asset may not be performing well, and it may be a situation where you're doing a loan workout with your lender, but you may have to couple it with a capital contribution from your investors to basically keep the contract viable and moving forward. So that's another thing to have in those initial documents. And so we recommend that basically if people are doing a syndication, they have the subscription agreement, that it contains all the disclosures and the disclaimers that we normally recommend. I mean, basically letting people know you could lose everything. We hope that it does well. We'd like for you to be a part of the project, but you can lose everything. But also making sure that if you're going to be claiming an exemption under Rule 506B or C, that the investors that you're obtaining are accredited. They basically meet the net worth requirements, or they have a certain level of business sophistication, and to basically have checklists for that where the investors can verify that for you, so that you're not running afoul of any securities regulations. And then, although a lot of clients don't do it, simply doing the online exemption filing, if you're basically taking advantage of that particular rule, doing that as well. Because when things are going fine, you're not going to have issues. But when things go sideways, disgruntled investors will be looking for reasons to sue you, or looking for things that you failed to do. And so it's very important to have things correctly papered, check those boxes off, and to have an attorney that's familiar with that process to help you along. Because you just need to be prepared for the what if situations and when things don't go as planned. So those are most of the things that people don't really think about on the front end. And it's, again, too many people oversimplify what's involved, because they may think, okay, well, I need some document. Let me see what I can find online. Just because you pull something off the shelf doesn't mean it says what you think it should say. And having an attorney who's also seen could go wrong and has handled investor disputes, it's very helpful for them to look at that and help you draft that language. It's, that expression you hear very often is an ounce of prevention is worth more than a pound of cure. I think for something like this, where you're handling other people's money, I think it's very critical.
Yeah, because it's all rainbows and sunshine when everything is going great and everything is profitable and there's no interest hikes, etc. But as soon as things kind of veer off the road, that's where the turbulence come in, and people begin to become frustrated and look for different avenues to go down, and that's where the turbulence begins. So you definitely want to have a seasoned person. And a lot of times, from what I've seen amongst a lot of syndication attorneys, it's almost standard documents that they push out the door, or either they just hit send from a file that they've given to the last 20 syndications instead of looking at your unique situation and going into details such as you described there. So that's really good that you guys take a look at each individual syndication and prescribe exactly what that specific investment and that specific investment group absolutely needs. So good for you, Richard.
And one thing that I did leave out, Eric, that is definitely worth mentioning for any syndicator, particularly new syndicators, is you want to make sure that any fee you're charging, whether it's just an acquisition fee or a disposition fee or a refinance fee, that you have it very clearly disclosed from the beginning in all of your investor materials, because you want to be able to pass that red-faced test, as they say, in terms of, or a straight-faced test, where if you're taking a fee later, you want it to have been disclosed. And I wouldn't even bury it in a footnote. I would be very clear about it, so that when you do take it later, no one disputes it. There also are certain things in terms of transparency that are critical. So some of my clients that have been having struggles because maybe returns aren't being made because it's a challenging market right now, continue to have very open communication and meetings with their investors. They're not playing ostrich. They're not sticking their heads in the sand. And sometimes it's how you handle yourself in moments of adversity that really show the content of your character, and your credibility in doing deals. And so that's just one of those things that I would recommend to everybody. And sometimes you're going to have documents that say, okay, I can take this fee. But sometimes if you're not making the returns, it may be in your best interest, particularly from an optics standpoint, to not take your fee. And, particularly if you're not meeting the returns of your investors too. So just something to keep in mind, in terms of folks that really want to have the long-term perspective and to continue to be able to raise money in the future, is just never losing sight of those aspects as well.
Yeah, so that's a great word of wisdom, and especially in this environment where there are a lot of turbulent times in which some people and investors has had to push pause on distributions, to make sure that you're not taking a fee shows alignment with your investors and at least gives them the peace of mind to be able to know at least that you're trying to get in alignment with them and not taking fees that you could take. And so that definitely would go a long way. So, hey, Richard, we want to thank you for coming on to the show. You've been a wealth of knowledge. You provided us with some really great details surrounding real estate syndications, real estate syndication documents, and also shared a great transaction that you was a part of, and which you helped an individual get really creative and walk away with a great investment. If someone listening to this podcast episode decided that they wanted to reach out to you, what would be the best method for them to do so?
My email address, and this will blow your mind, but I'll give you my mobile phone as well, and I will get the message, and we'll get back to you very quickly. My mobile phone is 757-353-0969, and my email address, which works just as well, is richard.crouch, and that's like Crouching Tiger is how you spell it, CROUCH, at woodsrogers.com. And so that's Woods, plural, Rogers, plural.com. So richard.crouch at woodsrogers.com.
Okay, Richard. Well, once again, thanks for coming on the show. We'd love to have you back anytime.
Thank you. Thank you for having me.